Really falling quite a bit. I am, though, struck by the idea here of the weakening in the economy. This is Bloomberg Markets, The Open. I'm Lisa Abramowitz in for Jonathan Ferro. It is a very special day. I'm here with Tom Keene at the IMF headquarters here ahead of their spring meetings. And I have to say, Tom, an incredibly busy morning with a trifecta of themes. We've got the earnings, we've got the Twitter takeover, and then we have a world beset by a series of crises. They all go together in a stew of uncertainty.
Yeah, to capture the moment here, and it really is distilled on an international basis down to this building, which is financial crisis, food crisis, and the rest, wrapped around a news flow today. I mean, forget about the suspect being apprehended in Brooklyn that was a focus of New York. Banks today. We have Lagarde just speaking and demonstrably moving the euro. We need to make clear, folks, we have euro down testing 107, not there yet. And I think of Jordan Rochester saying 105 is a critical point for euro. But all of this wraps around, and you mentioned this earlier, it started in Peru.
Yeah, the idea of how much social unrest, political upheaval is stemming from some of the world food shortages and the higher prices that we've been seeing. We do want to start, though, since this is the opening bell and we are seeing stocks fall a bit as we open here. We do want to start with what we're seeing out of the banks, particularly Citigroup and Morgan Stanley and Wells Fargo. Yeah, although Taylor Riggs is covering all the stocks moving ahead of the opening bell, in particular the banks, and I really do think there's a theme emerging. Those having to do with the U.S. economy and the consumer seem to be having a harder time. Those being traditional investment bank trading houses doing a better time. Bloomberg's Taylor Riggs here. Taylor.
Yeah, Lisa, you are spot on. Let's take a look at those and some of the early movers, of course, this morning. I think you really highlighted it well. Overall, sort of a beat on the top and the bottom line coming in better than expected. Wells Fargo, of course, might be the relative underperformer as you're thinking about perhaps maybe where some of the other banks are, some of the other financials, where those are. Overall, though, as you mentioned, a lot of the CEOs coming out in those comments and really, I think, highlighting that fine line of a lot of volatility to help improve some of that trading activity, but not too much volatility where you start to see clients really pull back. Of course, some of the macro headlines you guys have been discussing all morning with the war in Russia and Ukraine really front and center as you think about the financials, and of course, yields rising again this morning. Lisa, there is a big story that Tom did not mention, and that's where I will tackle it next. It is Twitter. Take a look at the shares as we take a look at the opening bell here. We knew, of course, Elon Musk coming in and trying to have that 9.1% stake, saying that he was going to join the board, then saying, of course, he is not going to join the board because the news this morning is he has announced sort of an all-cash offer of $54.20 a share, all cash for a take private of Twitter. We are getting further headlines here, Lisa, that Twitter is going to be meeting to discuss that proposal from Elon Musk, and that board's set to meet, according to another network, within the next 30 minutes. It is the big news of the day. You have shares of Twitter. They're up just about 5% or so.
Taylor Riggs, thank you so much for that. What do you think? Elon Musk taking over Twitter, honestly, Tom, I think about them taking it private. What he's hoping to do to fix it is subscription.
It's just what he's going to do. This guy has a history of success of doing this. I can't emphasize enough, whatever you think of the economics and physics major from Pennsylvania, the fact is, whatever he touches, Tesla, it's going to fail.
Yeah.
Tesla's going to, PayPal, that's a joke. I mean, it's a joke. And so who am I to say, or anybody else to say, that he can't do pixie dust 3 times with Twitter?
Well, let's see what happens. They are going to meet. This is a $43 billion bid. We can analyze the $54.20 price tag. I'm sure that many have numbers of interpretations of it. Wedbush Dan Ives was weighing in on this, writing, quote, "The soap opera will end with Musk owning Twitter after this aggressive, hostile takeover of the company. Get out the popcorn," as we expect many twists and turns in the weeks ahead. He nailed it. We have the popcorn out. We see the bid right now. Dan joining us now. Dan, where would you see this offer going? I mean, how much do we end up with something that resembles the bid at hand with an acceptance from the board?
Yeah, I mean, I think the board will come out with the standard cookie cutter. They've seen the bid. They'll evaluate it. They don't think that it ultimately values Twitter to where it should be. And that's where this becomes a classic corporate raider hostile bid, because ultimately their back's going to be against the wall. I mean, the Twitter board, they'll be eating lawsuits with breakfast if they don't seriously look at this, we believe ultimately accept it in some form, and then they're going to be forced into a strategic process. So ultimately, one way or another, Twitter, the way it stands today, I think this really puts the end in that story.
Dan, you've been prescient on all tech. Is Twitter going to be within the big tech sphere as it heads toward private ownership, if that is where it's headed? Or is it going to fall off the map as an esoteric side project of a billionaire looking for influence?
Yeah, and look, that will obviously be the worry here. But look, if Musk, as well as potential with partners, ultimately goes down the $40 billion bid, he's not doing it for just a project. I mean, this, as Tom talked about, from PayPal to SpaceX to Tesla, he's had the golden touch. And that's why for investors that have been so frustrated with Twitter, in terms of monetization, advertising, and really in the right-hand lane, going 45 miles an hour, other platforms, Instagram, TikTok, are passing on the left lane at 90 miles an hour. That's the frustration. And I think, look, this soap opera, it turned into a Game of Thrones where I believe Musk ends up owning Twitter.
Yeah, but we weren't worried about the price-to-sales ratio of King's Landing in the 4th season of Game of Thrones. Dan Ives, help me with the core ratio here. The income statement's a mystery. The Tesla accounting, frankly, is a mystery. Are you going to analyze Twitter straight on a price-to-sales ratio analysis?
I think there needs to be a combo, because you got to assume there's significant cost cuts as the bankers and as well as the due diligence when they come in. They could break up the platform strategically as a private company. I think that's where they could really go through the makeover. You could buy some other social media company, combine with it, and then maybe a few years later send that by. Look, Twitter is a flagship social media platform. I don't think that goes into oblivion here.
Dan, you are expert on the culture of these companies that has led to this massive free cash flow. Why are the other companies running from Twitter as Mr. Musk embraces it?
Look, clearly the freedom of speech issue is really what brought him to Twitter, but there's a monetization story as well. I think many view Twitter as a platform that really couldn't be rescued. Obviously new management team, but Dorsey in the background. And I think, look, Musk, he's been able to see gold when others see copper. And I think that's really what's happening here. And now, look, the street will debate if it happens, at what price, what's the regulatory. There's going to be a handful of twists and turns ahead. But this is a formal bid. And, obviously Musk being a corporate raider of Twitter wasn't something on the crystal ball going in 2022.
I got to say, Dan, I'm looking at the shares right now, $47.40, well below that 54.20 bid that we heard from Elon Musk. Do you think that people are underappreciating the likelihood that this will go through at levels that it currently is at?
Yeah, I think, and I can tell you from talking to investors, the street will, there's concerns about the financing, so that's one. Two, given it's Musk and the 420 tweet and whatever, it's like, okay, is this just another sort of sideshow project? And then three, I think there's ones that they'll be worried about regulatory and other sort of hurdles here. But Lisa, it goes back to, like, as we've seen over the last week and a half, like, this is a serious bid. It's formal. He has advisors. This is not just some project. And I think the street will be more and more convinced of this. And remember, now they're going to search the globe looking for any other bidders, because ultimately they don't want to come to the boardroom asking to us. For a Twitter board situation, this is kind of their worst nightmare.
So right now, you're speaking to one of the preeminent experts of tech. Dan Ives, you have come out again and again as a bull, and rightly so, on so many of these names. We have seen tech flat on its back over the past couple of months, and we're seeing a lot of underestimation. How much do you take a look at Twitter and say that it is part of that story and is undervalued at this point versus something that really does need a complete overhaul in order to really deliver the profits necessary?
Yeah, I think it's definitely more of an overhaul, in terms of from a platform perspective. Social media has changed dramatically. We've seen it with Facebook. I forgot the Meta. And, we see the Apple iOS changes have been the gut punch, which is really the change in social media. It's an arms race. And that's why Twitter is in need, I think, of a clear overhaul. But, this is really getting into a tight wire app in social media in terms of the monetization versus the advertising. And Musk looks at this. This was a now or never. This was the time, especially with Dorsey in the background. And now this is a good old 1980-style hostile takeover with Musk leading the way.
Right. Dan, one of the great features of securities analysis is none of you are on speaking terms. I'm sure you haven't talked to Jim Suva over at Citigroup. He comes out and says, look at the share buyback. He's on the edge of Ives here. Do you have to see with the enthusiasm of Jim Suva at Citigroup and, frankly, others for use of cash at Apple, do you suggest you've got to move up your price target on Apple this morning?
Look, I believe as we go into earnings on the 28th, that's going to be a catalyst from a buyback. I think the demand story continues to be underestimated. And Tom, I talk about base case 200, but I believe bull case is 225. And I think Apple gives us what we want on the 28th. And right now, the haters are hating across the board on tech. They hate Apple. Yeah. And we believe that's going to be a positive catalyst.
Which product category are they hating the most?
It's the iPhone that the story's done. It's in the rearview mirror. It's over. And Tom, as you've talked about, they said the same thing in 16, 18, and 20. And that's why it's one where I believe this is, again, over a $3 trillion market cap. And as they navigate, it's going to be the strongest product cycle in a decade in Cupertino, along with services, which we believe is worth $1.5 trillion.
Dan, do you expect that the companies within the tech world that cater to social media are going to have a difficult and rockier path going forward, even as the behemoths sort of reassert leadership, in your eyes anyway, in the stock market? Do you think that divergence between those that provide products, those that have cloud, and those that are social media will continue to widen?
Oh, it's a great point. I think there's a haves and have-nots, a fork in the road for tech. Enterprise, cloud focus, product focus, especially on 5G and what I view as the sort of digital transformation. Those are names that continue to go higher. I think fourth industrial revolution. The others, especially ones that were work from home beneficiaries, they're right now going to be battling in the sandbox. And that's essentially what's happening with Twitter as they've been losing share.
Dan Ives of Wedbush, thank you so much. And we're here, of course, battling in the sandbox at the IMF.
I can't pull the trigger on Apple. I can't pull the trigger on Apple. I miss Twitter, and I'm sorry, I'm triple leveraged all cash, and I'm staying there.
Yeah, you're going to stay there?
Apple, the iPhone's going to fail. The iPhone's going to fail. This is a running joke I've got with Dan Ives, folks, off the great Lawrence Haverty as well. I was with Larry Haverty with Matt Miller on the shores of Fifth Avenue, and it was one of those times where the iPhone 3 or 4, whatever, was going to die as well.
Yeah, I love it. Was watching the lines around the block at an Apple store to go buy a $1,000 product that looks like you're going to a supermarket.
This has been truly an extraordinary day, including John from Capri emailing in from lunchtime there with an umbrella in his drink. But what is the one observation you have so far on today as we await Stent and Jurgen and then on to Georgieva?
The one observation was crystallized by the ECB press conference, where they were focused on higher inflationary pressures from the war in Ukraine, from the post-pandemic realities, mixed with a worsening economic outlook. It is very simple. Higher inflation, slower growth. What do you do when you have relied on monetary policy trying to combat inflation that seemed to never get high enough at a time when suddenly it's absolutely the opposite? You're seeing that with retail sales. You're seeing that also with earnings.
My single observation here is one single moment with Geeta Gopinath, the chief economist of the IMF, now deputy managing director. And Lisa, when she talked about WTO and their analysis for next week's Blue Book, where they're banding positive global economic growth. I have never framed in my mind negative global economic growth.
Yeah, and I think that people don't really want to, and yet you have to prepare for that. That seems to be the theme. And coming up really is a conversation that you really cannot miss from the IMF headquarters ahead of the spring meeting. We have Angela Stent of Brookings and S&P Global Vice Chair Daniel Jurgen, giants in the field.
They're on speaking terms. It's amazing.
They are, in fact, married, I believe. That conversation is still ahead as we walk on markets. We are seeing right now also the euro extending the drop to the lowest since May of 2020. This is Bloomberg.
That's a reasonable option. I think that for us, because federal funds rate is very low, we do need to move policy back to more neutral levels later through this year. My baseline assumption is a neutral nominal federal funds rate in the long run is probably still in the very low 2% to 2.5% range. I don't think that's changed, but again, we have to have an open mind and see how follow the data.
That was New York Fed President John Williams speaking with our own Michael McKee on a singular moment for monetary policy. He is fired up. Everyone's fired up. How do you cater to uncertainty at a time when really there's inflation that we have not seen since 1981?
When we're done with the show and you and I are up for lunch at Ben's Chili Bowl, can you explain R-Star to me?
Anytime.
It's got like 4 plugins in it. I still don't, to this day, I don't understand.
Well, right now we are looking at markets that are down, in particular in the tech space. And I got to say, interesting to see that Twitter shares are up only less than 2% even after
Well, let's review that. That's serious.
Yes.
They popped to 54 earlier this morning.
Not quite 54, but now they're $46.69. People are not necessarily buying that it's going to go through. I have to say, let's not delay, because right now our next guests are the preeminent thinkers in both Russia and energy space, and this is important.
We've been doing this for years, and I think of one moment at Davos, Ken Rogoff and Joe Stiglitz at Davos a couple years ago, but they weren't married. This is wonderful in international relations.
We think.
To have with us Angela Sten, and she's brought along Daniel Yergin this morning, with true expertise on Russia and our shattered commanding heights. Wonderful to have both of you here. I want to begin simply with, I did a survey last night. I called up the New York Times and I said, okay, I try to read every wedding announcement. The record for number of academic citations in a wedding announcement was a few years ago when you two got married. You were at the Times of London, right?
No, I was actually while I was doing my PhD, I was a correspondent for the Times Higher Education Supplement.
And what were you a bum in the subways of London or something?
Yeah, I was floating around as a graduate.
Floating around as a graduate. How did you two meet? I mean,
we met in a class on French history at Cambridge University.
She allegedly ran out of ink, and I gallantly produced a pen.
Are you serious? It's in the Smithsonian now, and he's written every book on it. Let's get to this. And Angela, I want to start with you, and I've got a quote that's ugly. So we're in our studios in New York, and Bloomberg Surveillance is always trying to be smart and be immediate. And I look down at my screen of 10, 15 monitors, whatever it is, and there is Vladimir Putin in the far east of Russia doing a junket, first time really after the beginning of this war. Associated Press did a translation of his comments clearly for the Russian consumption. Putin, 2 days ago. The only question was one of timing. The thing we do, on the one hand, we help people, saving them from Nazism. On the other hand, we take measures to ensure Russia's own security. He reaffirms this concept of Nazism in Kristina Goryeva's Eastern Europe. Where did that come from?
Well, this is a way of dehumanizing, the Ukrainians, right? The great moment in Russian history that Putin keeps talking about is the victory in World War II, where the Soviet Union defeated the Nazis. So if you say that the Ukrainians are Nazis, and they're committing genocide against Russians, which is what he's also said, then in a sense you tell these young recruits on the field to go out and kill these Nazis. And even those Russian soldiers are confused, but it's the dehumanization and the demonization of the Ukrainians.
Angela, do you think that within Russia there is a realization of what has been given up for the stability that Vladimir Putin has represented over the past number of decades?
I don't think the Russian population fully understand that yet. I mean, they can see things are disappearing from their shelves. It's hard to access ATMs. They're getting poorer. But they're being fed all these lies. They're being told that they're defeating Nazism and that if they don't do that, Russia itself will be invaded. So I think we have a reckoning to come, but I don't think we're there yet.
And Dan Yergin, with your expertise on the energy markets, they are being kept afloat from some of these oil and gas receipts. And we have seen that Vladimir Putin today came out and said it is going to be very difficult for the world to move away and Europe to move away from their gas. Do you see a different story?
Well, to some degree. I mean, they're right now, this year at this price, they're going to earn about $250 billion from European purchases of oil and gas. I think we're going to start to see sanctions. I think the last 2 weeks have really changed in terms of what people have seen as the Russian troops have withdrawn, as the war draws closer in the Donbass intensity. And so I think we're seeing the self-sanctioning, and I think it'll be progressive sanctioning that will cut back on energy. Oil will be easier, particularly crude oil will be easier to cut back on than gas. That is his strongest point right now. But I think you're going to start to see that too. The pressure just will mount.
Are the commanding heights shattered?
solution is for the U.S. and its allies to keep arming the Ukrainians and to enable the Ukrainians to push back against the Russians so that the Russians really can't declare victory. But Putin's not going to accept that yet.
How long do you think it will take for people to really move away, Europe in particular, from importing gas from Russia, to truly isolate Russia to the degree that many people are expecting?
Yeah, I think you should take that, but I think it'll take a long time.
You know, I think we'll see crude oil first. I think that the pressures definitely will grow and the restrictions. I think you could start chipping away at the gas, and I think people are saying, well, maybe it'll start with not taking Russian LNG, for instance, into Europe. And I think 2-3 years. I mean, what the Germans have to do is build those receiving stations for LNG, and over the next 2 or 3 years. But I think it could actually come sooner, depending what horrors come out of Ukraine, and the pressures will be so great.
Angela, one final question to you. There is a primal scream for the cliche of a Marshall Plan. How do you envision a Marshall Plan of the allies to Ukraine?
Well, it's going to be incredibly costly, but obviously they are going to have to pay.
And
for the
Yellen mentioned this yesterday. She says magnitude is the issue. We're thinking in billions instead of trillions. Do we bankrupt ourselves? You be quiet. Do we bankrupt ourselves?
We have all of these Russian assets that we've impounded. We use those also partly to pay for it. We force the Russians to some extent.
Yeah, that's what I think. We'll use the Russian assets, and we'll use those Russian yachts as long as you can find buyers for those yachts.
Well, that's a key question. Yeah. I mean, can you, if you're talking about what?
Brokers. Where are the
$700 million for Vladimir Putin's yacht. You want to buy some for your honeymoon, your third honeymoon.
This has been wonderful. We hope we can do this
again.
Please,
and for longer.
It took months of negotiations.
And between us.
Who has the next book coming up?
At the moment,
we're still both so engaged. We're living our current books every day. Every day.
Angela Stetton, Dan Yergin, thank you so much.
The next year, a book of mine of a couple years ago, and I can't say enough about Putin's world. I just can't say enough about the immediacy.
Two giants in the world, and truly wonderful insights. Thank you so much for being with us, and we hope that you do join us again. I do wonder if that's a likelihood that we could see actually Europe move away from oil and gas from Russia over the next 2 to 3 years, and what that means in terms of the other areas that you're going to rely on, how that really fits into the whole.
I don't see, as Dr. Yergin mentioned, it's doable if you do this, do this, do this, and the timeline of do this, do this, do this needs to be reacquainted with what we saw after World War II and other moments. Let's go, let's go, let's go. It hasn't happened.
With a whole lot of money behind it, as you mentioned correctly. We are also looking at the consequences of that, and right now in markets you are seeing they are softer, with the NASDAQ down 0.7% and the NASDAQ down 0.3%, really stemming from some of the weakness that you're seeing, not only in retail sales. You know, it was really quite negative when you look at it on an inflation-adjusted basis, but also the comments out of Christine Lagarde were stark with respect to the economic ramifications should there be harsher oil and gas sanctions, and frankly, as a result of faster inflation, and yet not necessarily seeing the growth. What a busy morning.
It's incredibly busy morning. What's most amazing about this is Kristalina Georgieva read Dan Yergin's The New Map cover to cover. So she's going to join us for a book review of that. Coming up, the managing director of the International Monetary Fund, a spirited discussion from the gentle lady, truly from Eastern Europe.
Yeah, this was Bloomberg Surveillance special edition, and I got to say, more special even still to come. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day. It's Thursday, April 14th. Here are the top market stories we're following for you at this hour. Musk's Twitter bid. Elon Musk offers to buy Twitter and take it private in a deal that values the social media company at $43 billion. Shares soaring as Twitter reviews the offer. And the ECB sticking to its plan. The European Central Bank is sticking to the plan to end its bond buying program in the third quarter, even as the war in Ukraine fans inflation. We're going to discuss the international implications with IMF Managing Director Kristalina Georgieva. Banks, they beat big. Wall Street's biggest banks posting first quarter results with trading revenue driving enormous earnings beats. We're going to break it all down for you. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guy, a fascinating morning, which was supposed to be very quiet going into the long weekend in the United States and Europe, really coming out with a lot of breaking news on the eco front, on the ECB front, and of course on the Twitter front.
I can't quite work out if you took today off to try and get ahead of the traffic, basically, are you a genius or did you fail massively? Because as you say, a lot of things have happened this morning and a lot of things have been turned on their head. You got the euro crashing, you got this Twitter bid, you got Williams talking about 50 basis point hikes, you got the data hitting the Bloomberg terminal. Let's talk about that now and figure out what is going on. I'm a little surprised by these numbers. So we get the University of Michigan Sentiment Index. 59.4, the last number. We go to 65.7. I'm trying to work out why. Current conditions, 68.1, up from 67.2. And the expectations index, this is where things have really changed. The expectations index has gone from 54.3 to 64.1. Like, I saw this number hit the tape and I'm like, is that a typo? Because the prior number was 53.6. The inflation numbers stay elevated but are below expectations. Expectations was that the one-year inflation number in terms of the survey, given where gas prices are, though they are starting to track down a little bit, would come through at 5.6. It's coming through at 5.4, which is basically static to where we were last time. I'm still trying to get my arms and my brain, to be honest, around that expectations number. 64.1 is what we get there. We'll come back, we'll talk more about that in just a moment. The other story obviously we've got to focus on is what is happening with Twitter. I'm not massively surprised by this. I think a number of people probably aren't. After he decided not to take the board seat, he was obviously ruminating on other options. So Twitter says it will review Elon Musk's $43 billion offer to take the company private. The world's richest person says that the company has extraordinary potential and he apparently is the person to unlock it. Joining us now is Bloomberg's Ed Ludlow. Ed, first of all, I want to deal with the mechanics of this.
Right.
How does an individual pay this much money for a company? Does he just write a check? How does it work?
Yeah, it's the question, right? And as with all the stories in the last few weeks on Elon Musk and Twitter, there are more questions than answers at this point. But $43 billion, $54.20 per share in cash. You know, I've spoken to a few on the buy side this morning that point out that a lot of Twitter's holdings are held by passive funds, you know, that use index products. And when is the last time in history you can recall, Guy, where an individual, not an institution or an entity, but an individual made an all-cash offer for $43 billion? And, you know, Elon Musk said in the letter to Twitter's chairman and board, this was his final offer, no back and forth. But I would say that a number on the sell side point out this morning that we could see him increase that offer because, you know, a year ago, Twitter shares were much higher than they are now.
Ed, what's interesting to me here is that the Elon Musk vision essentially for Twitter, a lot of it includes subscription bases. It also includes perhaps targeting Twitter Blue and some of the other kind of pieces of Twitter that they have actively been trying to monetize and just haven't been able to do it as aggressively. My question to you, though, is what happens if this offer doesn't go through? Is the expectation on the street that Twitter is still able to recover, or with the Elon Musk bid and interest gone, do Twitter shares collapse?
Yeah, look, the consistent line from Elon Musk across all of the regulatory filings that we've had in the last 10 days, 2 weeks, is the potential to be a platform for free speech. Free speech. Guy and I were talking about this on radio the other day. Elon Musk is fixated on free speech. And the background to this story is that when Jack Dorsey stepped down as Twitter CEO in the last week of November last year and Parag Agrawal became CEO, Elon Musk tweeted a meme. And the meme depicted Agrawal as Joseph Starling pushing his then head of security into a river. And the inference that was drawn at the time was, A, that Elon Musk wasn't a big fan of the new Twitter CEO, but B, there were some ideological differences. And by extension, what the street drew out from that was that there was a concern about content moderation on the platform. So you'd expect that to start.
Ed, why is the stock trading at 47, not 54?
The market being sanguine, the market not jumping the gun. I mean, the other line, and sorry, I'm referring to the text of the letter that Elon Musk sent to Twitter, but he basically says that if the offer's not accepted, this is his best and final offer. If it's not accepted, I would need to reconsider my position as a shareholder. You know, it seems like every possible outcome is still on the table. This is the problem with the situation, that we're going on the wording of the regulatory filing. He says this is his final offer. What if he makes another offer? What if the board rejects? What role is the SEC going to play in this? I realize these are all questions, Guy and Critty, not answers. But this is the problem with how Elon Musk operates. And if you read across the sell side notes that have come out very quickly this morning, everyone's split. Dan Ives of Wedbush thinks this will go through. It's going to happen. Others think that he's lowballing the price, that he will come back with a higher offer. And others think that it just won't happen at all because of the complication of making the deal go through.
Well, Bloomberg's Ed Ludlow, thank you so much. And of course, we know that Ed's going to be following the story, monitoring it throughout the rest of the day. Thank you for your time. Let's turn now to the other big story of the day, and that, of course, is the European Central Bank and its fight against inflation. President Christine Lagarde spoke to reporters after the ECB renewed a pledge to end bond buying in the third quarter.
Price rises have become more widespread. Energy costs are pushing up prices across many sectors. Supply bottlenecks and the normalization of demand as the economy reopens also continue to put upward pressures on prices.
Joining us now is Jens Eisenschmidt. It's his first TV interview since leaving the ECB for Morgan Stanley. He is now Morgan Stanley's chief European economist. We so appreciate you joining us today. Give us your takeaway of simply what we've heard. Going into this meeting, we know that the market was extremely hawkish. Now, this kind of commentary from the ECB and from Christine Lagarde, perhaps interpreted as a little bit more dovish than expected. Is that your read of the situation?
Yeah, I mean, first of all, great to be here with you. And let me first stress that we were actually not surprised. So, I mean, essentially, today's outcome was as also broadly by us expected, with one small tweak to that, but I will come to that in a second. So first of all, they are sticking to their script that they have basically announced in March, and as Christine Lagarde was also saying in the press conference, that actually dates back to December. So the December was really the start of the end of the super accommodative monetary policy. So in December they announced the end to PEP, plus some APP envelope behind that until October, and then maybe some rate hikes in 23. In February, they were jumping a little bit ahead, so we speed this process up, and because we have seen inflation surprising to the upside, so let's speed that process up and have maybe an earlier end to this APP and have tightening a little bit earlier, so no longer ruling out any rate increases in 22. And in March, there was the war as a new development, and at the same time, they have said, okay, we have seen additional inflation surprises to the upside. So what they then essentially said, okay, we will have guidance for Q2. That's 40, 30, 20, which they reiterated today. Plus, we say we will end in Q3, and then we will see what happens to rates. And they said exactly the same. There's one small difference, and let me underscore this, which is very important, because what the market saw as dovish, actually from the ECB's perspective, is hawkish. Basically, they said instead of keeping it open and say, well, net asset purchases end in Q3 or could go thereafter, they basically said, now I think we are more certain than we were before that net asset purchases will end somewhere in Q3.
The market has not taken it that way. Jens, the market's taken this as super dovish. The euro's trading 108 and sub 108. You've seen a big bid coming into BTPs today. Yields have come down really sharply. The market took today as dovish. Are you saying that that Lagarde has miscommunicated, that actually this is a more hawkish statement than the market is saying that it is?
No, I'm just saying that there are two sides to the coin, right? The market, I think, was getting a little bit ahead of itself, pricing a July hike. I think that was not something that you could essentially deduct from any communication coming out of the ECB, and I think they have been crystal clear on that. If anything, they have been recently highlighting the risk to growth, and that could mean that also APP may run for longer. And I think it's in a unique situation, and again, as President Lagarde was highlighting this in the press conference, there is an element here that separates the euro area from the US. It's a completely different economic setup, and they have this very huge risk, which is to the east. It's brewing, and they are more exposed than anybody else to that risk. And I think that essentially
is growth the biggest risk now for the ECB? Jens, is growth the biggest risk for the ECB or inflation?
So I guess that's what makes it so difficult, right? I mean, I think they are in a situation, they are faced with a shock that lowers growth and increases inflation. And I think it's just a question of magnitudes here in terms of what you think you have to act on. Now, I think, again, President Lagarde made it clear in the press conference, they have to avoid a situation in which high inflation stays there for too long, because at some point this starts to get ingrained in wage setting. So far, they haven't sounded the alarm bell there, but what they have been stressing clearly is that there have been first signs of, I would say uneasiness by some policymakers, that's the way I would translate that, as to how long-term inflation expectations look like. So in some sense, I think the name of the game is normalization, policy normalization, and what I read of today's, what I read in today's decision is policy normalization won't be derailed unless growth comes in very, very negatively.
Okay, Jens, we're going to leave it there. Great stuff. Thanks for jumping in. Really appreciate your analysis. So recently, obviously, at the ECB, maybe better able to read between the lines as to what is happening here. Please come back. We look forward to hosting you once again. Jens Eisenschmidt, Morgan Stanley's chief European economist. Thank you very much indeed. Critty, the problem today is that they didn't talk about FX. You've got an FX story that is beginning to develop. We got sub 108. The problem is that a lot of what Europe's inflation problem is centered on is energy. Energy is priced in dollars. That energy just got more expensive as Christine Lagarde was speaking today.
And I think the interpretation turned a little dovish because look at the phrasing that they use: confidence, trade numbers, and of course, to your point, the energy crisis. These are not necessarily the focus if you're talking about inflation necessarily. So instead of talking about the supply side, which really was the conversation a few months ago, they are very clearly looking at the demand side now. We'll see if they stick to that narrative.
The other issue that we've got to think about as well is on what happens with labour. The labour story is much slower to develop in Europe, but once we start to see second round effects in the labour market, gets much stickier. Anyway, coming up, central bankers and finance ministers from around the world are gathering next week for the IMF's annual spring meetings. We have an exclusive interview with the IMF's managing director coming up next. Kristalina Georgieva. Next, this is Bloomberg.
Bloomberg.
Good morning, everyone. On Bloomberg Television and on Bloomberg Radio across America and indeed around the world, not a usual interview at the International Monetary Fund. In these unusual times with the spring meetings in 1 week, we are out front with the first interview with Kristalina Georgieva, the International Monetary Fund Managing Director. An extensive interview, and I've made clear to her if she wants to go longer, we'll let her go longer all morning. So much to talk about. Thank you so much for having us here. It's been a wonderful conversation through the morning. I want to talk and go to a quote which I just spoke to Angela Sten about, the great author of Putin. This is Vladimir Putin in Russia 2 days ago, an Associated Press translation, obviously for the Russian audience. The thing we do, on one hand, we help people, saving them from Nazism. On the other hand, we take measures to ensure Russia's own security. You are more qualified than anyone. Your heritage of Bulgaria, your grandfather was a patriot of Bulgaria. You have lived under this, Karl Marx University and such. You personally must be thunderstruck. And with members of the greater Georgieva clan in Ukraine now, just for a moment, what has the last 50 days been like for you and your family?
It has been horrific. A war is a terrible thing. For my family, what it means is threat to their safety, more difficult to find food and more expensive to buy it, no medicines, and above all, that sense that the war would not soon end. Getting out there in Kharkiv, in the eastern part of Ukraine, is close to impossible. Why? They are very close to the Russian border and very far from the Polish and other borders of Ukraine. But in this horror of war, what impressed me the most is the strength that they demonstrate for the future of Ukraine. My sister-in-law's message is, we will win this war.
Can they do it alone? And the distinction of my interviews with the right and the left, the politically savvy and not, is this timidity about starting a World War III. Now, that's not your mandate at IMF, but I would like you to comment on how you perceive the shock of the Western world and their tentativeness in assisting not only Ukraine, but all of Eastern Europe, up frankly to Finland.
Well, the reality of this war is it is about Ukraine and it is beyond Ukraine. It is about Ukraine because its existence is being threatened, but also the post-war order is being threatened. And in this sense, the war affects all of us. If we are to allow a 21st century military takeover of a country in Europe that is detrimental to Europe, it is detrimental to the world. And what we have to recognize that the war is having consequences reaching far and fast. It affects hundreds of millions of people through three main channels. One, commodity prices, especially food, energy, but also metals. And food prices are up at the time they were pushed already up by bad harvest in many places.
I want to talk about the food in a minute, and that's going to be the main part of our conversation with what we see as the challenges of the IMF in helping Sri Lanka, Peru, and others. But I want you to comment on the scope and scale we see. This is something you're expert in academically, and another expert, Janet Yellen, who has a little bit of experience with the trillions word, says we're getting the magnitude right. Yellen says we need to think in trillions, not billions. As you go to your spring meetings, and frankly, to your October meetings, do we have the magnitude wrong of what is needed?
Well, Janet Yellen is right. We need trillions, and we have been talking about these trillions for years. How can we transform billions into trillions? Well, first, by all of us working together. We cannot have fragmented deployment of scarce development international finance resources. Two, by embracing a very simple principle. Public money should be used for only one of two things: to finance what private money would never finance, and to remove barriers for private finance in emerging markets and developing economies. And we are still short of embracing entirely this principle. At the IMF, our concentration is, when we have a program in a country, is this program going to open up space for private sector-led growth, for jobs that come because vibrant investments are being made? And when we look at the countries that are now in difficulty, we are determined to help them have fundamentals that would make that private sector-led growth possible.
I want to talk about the mechanisms here and then get to the food crisis. Our Eric Martin is front and center on this and looking nation to nation at where the greatest challenges are. The nuance here is the solution domestically for these troubled nations in food is price control. To keep the price of bread down, to keep the price of wheat down, the price of rice down, etc. The IMF comes in and says, okay, you're broke, fine, let us help you fix it, but there needs to be a new mechanism given the magnitude and the shock of this inflation. Explain the new mechanism or process you will use to move from domestic controls over to something that's more modern Western capitalist. How do you get from A to B?
We have been on this now for quite some time, and you're right, we have to get even faster on that path. And what we are working with countries to do is to have targeted assistance. So there is social protection that identifies who are the vulnerable that need to be helped. What is the problem with price controls? Everybody benefits from it. The rich benefit and the poor. But if the country doesn't have a social safety net, if they don't know who their vulnerable families are, they are bound to go for price controls because that's the only thing they can do. And by the way, at this moment of time, in some circumstances, we would say, this is not your first best, it's not even your second best, but given the speed with which prices are jumping, there is some logic in making sure people don't go hungry. How do we think about this in the future? We have two complementary strategies. One is what I just described. Target your public spending. For God's sake, don't throw good money in the direction of rich people. Second, think about food in a more sustainable manner. Remember, this year, food crisis has already been knocking on the door before the war because of climate change, because of climate shocks, because agriculture in Africa is rain-fed. You have no rain, you have no food. We have to think about sustainability and resilience in a more shock-prone world differently.
Okay, but I want to digress here, and I do want to come back to food. And folks, if you're just joining us on Bloomberg Radio, Bloomberg Television, Kristalina Georgieva, the IMF Managing Director, here in a conversation, I can say in all my years of doing this, a critical point into the spring meetings of the IMF next week. I want to digress here on climate change. I was at the Paris Accords and the advancements that have been made. Tell me of the derailment of the need to burn coal. How temporary is that, or has there been a seismic shift for climate change?
It is temporary. I don't see coal persisting for much longer. Why? Because one of the benefits, the silver lining, if you wish, of high energy prices is they make renewables more viable. And they inevitably would accelerate.
You believe we'll see substitution in here to assist?
Yes. How long would it take? I'm not an energy expert. I would not guess. But the direction to travel is clean energy.
Okay, fine. Just because of time, I really want to get all these issues in. We see Peru, we see Sri Lanka, we see Egypt, which is a much larger, bigger problem. That's the focus of our Eric Martin. If I see these different companies in maximum distress, it alludes to the Arab Spring, to Tunisia, and almost a domino effect of an unraveling. Are we near not an Arab Spring, but a war crisis where we get a domino effect of food crises?
We have to get on top of the food crisis. We need to front it right now. And we can. We have learned lessons about it. We know how to do it. But even if we front it, more countries would be in trouble. Why? Because in 2020, everybody had to borrow more to sustain an economy in standstill. Largest increase in debt because of the pandemic. In 21, servicing this debt was easy. It was actually cheaper in some places because interest rates were so low or negative. 2022, no more. With tightening of financial conditions, servicing debt is getting more expensive. Now, good news, not so good news. Good news is that we see that, we follow it, and we are already zeroing in on the countries that are in need of debt restructuring. We have to press for that restructuring.
Well, you have Sri Lanka on Monday, right? They're coming into Davos, and they're going to come in here, and you're going to sit with Sri Lanka. How do you approach that?
We would sit with Egypt, we would sit with Tunisia, and we would discuss with them realistically what needs to be done. One thing that I saw, Sri Lanka has appointed very prominent Sri Lankan economists to be advisors. That gives me hope that they are saying, okay, we have to
Again,
solve
because
our
of time, I've got to move on. Everybody in G7 is focused on this except Mr. Macron. He's got to get reelected, so we'll give him a pass right now. What do you need from G7 to affect at maximum IMF tactics and issues in this crisis?
We need from G7 support for deploying the full set of instruments of the IMF fast. And we need space to build it for the future. Yesterday, our board approved a new instrument. First time in the history of the IMF, we have a long-term financing instrument specifically for pandemic preparedness and for climate action. What we want is to think of building that resilience I talked about in a more comprehensive way. Tom, before when IMF says resilience, we mean banking sector, financial stability.
Now it's broader.
Now it is broader. We have to have people that are healthy and educated. We have to have the economy more vibrant. We have to have digital money integrated today in the way we would function tomorrow.
You are a tough nut. The way you came up with some real struggle in Bulgaria, your academics and the work, and you've just got that certain manner of, you do this thing, and you're like, let's go, let's go, let's go. What do you say to the IMF nations supporting Mr. Putin, whether it's direct, maybe it's somewhat indirect, think India, China, etc. How does the IMF address those nations that aren't on board helping Ukraine?
Think of the interests of your people. Over the last decades of integrated global economy, we have tripled the size of global GDP. Tripled. Who benefited the most? Emerging markets, developing economies. Their size increased 4.5 times. Their poor people are fewer, their middle class has expanded. An integrated economy in which we can work together benefits you.
Kristalina Georgieva, thank you so much for joining us. What a wonderful start to the spring meeting. She is the IMF Managing Director, joining Bloomberg on radio and television. Back to you.
Tom. Thank you so much for bringing us that interview. Let's get a check on the markets here in New York. We're about an hour into the U.S. trading session. You have a little bit of red on the screen. Extremely risk-off day when you think about it. And remember, this is coming ahead of a long weekend, so it's pretty natural to see some of that cash taken out of the table, Guy. But we also have to keep in mind a lot of what's going on in the S&P 500 right now has a lot to do with what's going on in the bond market. Stick with me here. You can see a lot of the pain concentrated in tech. The NASDAQ 100 really taking it on the chin here, down 1%, reversing the gains of yesterday. And once again, a lot of that comes down to the bond market. I'm going to skip to the bottom here. The 10-year yield up a whopping 8 basis points. And remember, Guy, it's all about the margin of the move, not just yield higher, tech lower. It's about when you see these big spikes as much as 8 basis points that we're seeing right now. That's really when you get the bigger moves in the downside when it comes to the stock market. Speaking of the bond market, we also have to address what's going on here with the euro. And of course, that was lower. The 2-year yield higher. And this is really interesting because in Europe, we talked about markets kind of interpreting Christine Lagarde as a dovish tilt. The 2-year yield here in the States, it's all about the Fed and actually talking about a more aggressive approach. John Williams, in an exclusive interview with Bloomberg's Mike McKee, talking about 50 basis points, 100% on the table. Remember, he's also the second in command of the committee that helps make those decisions. And you can see immediately the 2-year yield seeing a little bit of a spike. We should also talk simply about what is actually moving when it comes to a micro basis. Bank earnings, Twitter, these are all going to be big movers when you talk about the individual stories. Bank earnings, remember, has everything to do with the consumer, and we've heard a mixed picture. Trading looks great, but loan loss provisions, a lot of preparation for what might be a recession in the coming years, and you can really see that commentary slowly trickle out. Well, really, it's that trading revenue that's pushing these enormous beats. And we have to talk about Twitter here because that bid, a $43 billion deal when Elon Musk potentially taking over Twitter, those that offer under review right now, really fueling Twitter shares up 2.2%. But Guy, in pre-market this morning, it was up as much as 15%. Really, I think the story, though, when it comes to the U.S. corporate space is going to be those earnings.
Why is Twitter trading below the offer price is something I think we're going to have to spend more time discussing. But as you say, Kriti, it's macro versus micro today. The earnings story, as you say, absolutely front and center, as ever, kicked off effectively by the banking sector. Yesterday, JP Morgan. Today, we get Citi, we get Wells, we get Goldman Sachs. What can we take away from the start of the earnings season that's going to be useful, that tells us things about what comes next? Let's try and figure that question out. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, joins us now. Lori, great to see you. The earnings season kicks off. The banks are starting to give us information about what is happening with the U.S. economy, the global economy, and their businesses. What's the takeaway, and what's the takeaway from what we've got thus far for the rest of the earnings season?
Well, thanks for having me as always. And, you know, it's an interesting day as usual. Look, I think that the banks always kick things off. We always spend a lot of time focusing on the banks. And so far, you know, I think what we're hearing from the banks about the health of the U.S. consumer is something, frankly, that I'm also hearing from consumer companies so far, which is that the sort of rumors of the death of the consumer seem to be greatly exaggerated at this point. And that's not to say that there aren't real risks out there that we need to take seriously. But Guy, one client after another keeps asking me why the market is up versus the lows in March. And I keep telling people because I don't think the market is actually convinced yet that a recession is coming. The risks are real. The logic makes sense. But we are simply not seeing evidence of a breakdown from corporate America yet. And I think the market is correct in sort of the levels that it's at right now.
Lori, I'm very curious about what a lot of these companies are going to be doing with the enormous amount of cash on their balance sheets, not just the banks, but you have tech, for example, and of course some of these other sectors that perhaps their stock has been under pressure in these last 2 years relative to some of these big tech flyers, but they also have a lot of cash on their balance sheets. Talk to us a little bit about how they're going to deploy that cash in an inflationary environment.
Well, look, I think that's a great question, Kriti. And we actually have been using the Bloomberg Transcript Analyzer tool. I'm going to give you guys a little bit of a plug to see what companies have been talking about in regards to cash deployment in terms of things like buybacks, dividends, M&A, CapEx, et cetera. And what we've noticed is that coming into this reporting season, discussion about buybacks is on the upswing. Discussion about dividends is on the upswing. We're also seeing that for CapEx. And I think that CapEx, expanding capacity, is one way that companies are trying to battle inflation, nearshoring is a theme we've been starting to read about a bit more. At the same time, though, we're seeing fewer mentions of M&A, which is something investors always ask me about. Now, we're not seeing a big upswing in comments about debt paydown right now, but I wouldn't worry about that because we actually saw a lot of conversation about debt paydown in 2021, which is telling me that companies knew the Fed was starting to move and were getting ready for it by cleaning up their balance sheets.
What are companies trying to communicate by focusing on dividends and buybacks at this point? What are they trying to tell their investors about the types of companies they are? What do you think the message is?
Well, look, I think that they are trying to emphasize that they are continuing to reward shareholders for investing in their companies. And on the dividend side specifically, we know that that is something a lot of retail investors, I'm thinking more of kind of the high net worth crowd as opposed to sort of the Reddit crowd. But, you know, that is something that retail investors typically do look to U.S. equities for. So I think they're trying to send a reassuring tone.
Sorry, Laurie. Is that an inflationary hedge? Are they looking for are they basically trying to communicate to their investors that they are an inflation hedge?
I think so. And look, we do see that borne out over time. If you look at positioning in U.S. equities relative to cash and bonds, it does tend to track CPI over time. So we do know that that's borne out in terms of behavior. And I think companies are trying to say, look, we're able to manage through these inflation pressures and still reward shareholders at the same time. So it's really, at the end of the day, trying to send a message of confidence.
Well, speaking of a message of confidence, I'm curious about the recession risk, because we talk a lot about this, that perhaps the United States, Europe more so, but the United States could see a recession down the road. But it doesn't seem like a lot of companies are necessarily that concerned about it from what I'm understanding. They're talking about a slowdown in growth. I guess the bigger question is, does that mean that they're going to start trying to pass on more of those costs to consumers and foresee that those consumers can't digest it? Talk to us a little bit about the margins picture.
So, you know, if we just start with margins, we know that companies have been talking a lot about margin pressures in recent quarter, really for the past year and a half or so. But the margins are far outperforming the commentary that we've seen because we are, again, seeing companies really emphasizing, hey, we've got all these pressures out there, but we're still able to manage through them. Pricing is one way they are managing through. And so we've actually seen a surge in commentary on pricing in recent call transcripts, earnings, and otherwise. And what we're noticing is that analysts on the sell side are really pushing companies to say, is the pricing strategy working? Are you getting pushback? And for the most part, companies are saying that they're still able to pass those prices through. And look, I think the demand discussion is one that's of utmost importance. We are generally seeing characterizations of demand as quite strong. Not quite as strong as they were a few quarters ago, but still very, very strong. And I think as long as companies are still saying, hey, look, the demand is incredibly robust, the underlying appetite to spend, both corporates and consumers, is still robust, it's very, very hard for investors to say, hey, look, there's evidence of recession out there. This smells like something different if you really look at what the companies are talking about.
Given that, given what you're saying about the recession, given what you're saying about what companies are saying, do you think the Fed's going to be comfortable with that? There is this fear that the Fed is looking at all of this and saying we're not getting the reaction, both from the corporate sector and also from the markets, that we need to see in order to drag down inflation back to levels that we're comfortable with, say sub 3%. Do you think the Fed is going to look at what is happening here with corporate America, what it's doing in terms of wages, what it's doing in terms of margins, and say, you know what, we need to go harder here?
Well, look, I'm going to leave the sort of Fed calls to my esteemed economist, Tom Porcelli, but I was talking to him about this issue recently. And one of the things he told me was, he said, look, you know, as we get later on in the year, if some of the data starts to look a little bit squishy, and squishy, you know, was his quote, not mine, but he said, I do think the Fed is going to sort of acknowledge that, you know, and I will say we did an investor survey recently, Guy, where we asked people about their faith in the Fed, and it's very, very low among investors right now. A big contingent of people who think they're going to tighten and go too far and impinge on growth. And then there's another decent contingent who think they're going to continue to let inflation go out of control. I would say maybe I have a little bit more faith in the Fed than either of those camps. And like Tom said, we'll continue to sort of look at the whole picture as the year progresses.
Laurie Callasina, head of U.S. equity strategy at RBC Capital Markets. We thank you so much for your time, your insight as always. Let's turn to one of the top movers of the day. Twitter shares higher as Elon Musk makes an unsolicited $43 billion bid for the social media company. For more, let's bring in Yigal Arounian, Wedbush Securities Managing Director for Equity Research. Yigal has a neutral rating on Twitter with a $42 price target. Yigal, thank you so much for joining us. We're looking at Twitter shares right now, hovering about $47. The bid, I believe, was for over $54. As Guy and I are both puzzled about, why is the stock so low?
Hey, well, the stock's up materially from before Elon Musk came into it. I think what the stock is telling us right now is that there's uncertainty whether the board accepts this offer or not. It's not a given. Just because he offered, $54 a share doesn't mean the board's going to accept that. And so there's, some hedging around that price, and that's why we're below it right now.
Okay, let's just talk about the kind of the question that underlies all of this. The offer is a take it or leave it, and maybe the stock's trading lower because maybe ultimately the market believes that the board says we're going to leave it, and then Musk walks away, and everything changes, and the stock goes down. And I'm wondering whether that's the scenario that's ultimately being priced in here. Do you believe that this is a take it or leave it issue?
So there's a couple of things in there. First of all, on that take it or leave it point, maybe not. It could be a negotiating tactic. Elon Musk is. Has known to change his mind, and just because he kind of put it out there that this is a take it or leave it offer doesn't necessarily mean that that's the case. Elon's coming at this from the point of view of, Twitter needs to be better about free speech, and it plays a really important role in society. Yeah. And, his view that Twitter and its management and the board hasn't done that justice over time. So if that's really what he's going after here, giving a higher offer and thinking about valuation, what the right price is, I don't think that shouldn't be what it's about, right? It's about him taking control and doing to Twitter what he believes the role it should play in society. So no, I don't think just because he said that it's the final offer necessarily means that it is. What happens to the stock if he does walk away and ends up exiting his stake? There's probably some volatility and some downside there. It puts more pressure on Twitter, its board and CEO to put up the kind of results that will make investors confident in the story, that its user growth and its revenue growth are on track to meet the targets that they've set. So it definitely puts a higher hurdle, especially where the stock is today versus where it was just a few weeks ago.
One of the interesting narratives, I think, in the last couple of years when it comes to Twitter was what might happen to Twitter when President Trump left office. And we know, of course, President Trump was very active on the platform. I'm curious what happens to Twitter shares if for some reason Elon Musk, as you pointed out, could potentially leave this offer and this deal could not go through. But Elon Musk is perhaps equally or even more active than President Trump on Twitter. Does that eat into the brand value of Twitter?
You're asking if Elon Musk leaves the platform and stops using Twitter as a platform himself,
or if he simply doesn't choose to go through with the deal. Really, any of those circumstances. The idea here that Elon Musk perhaps not as active on Twitter as a board member or even as an active participant.
So look, I think what Elon brings to the table for Twitter, which makes sense in his strategy here, is more valuable in a private environment than it is in a public environment. What public market investors will value in Twitter, I think, are different than what Elon Musk is valuing in Twitter. Right? For investors, it's about user growth. It's largely really about user growth, but it's about monetization of those users, where Twitter fits in the digital advertising and social media landscape, and it's about the numbers, right? That's the brass task for public market investors. So if he leaves, I'm not sure that, or if he would have joined, I'm not sure what the value would have been that he would have brought to the table there from the public market investor side. In terms of whether he, if he backs away and sells his stake and doesn't use Twitter as a platform anymore, I think Twitter is bigger than any one individual user. Obviously, yep. Elon Musk is a big personality, but I think there's so much more to it than that.
You wonder what the future of President Trump on Twitter would be post an Elon Musk takeover. That's an interesting question. We'll park that for a moment. Yigal, let's talk a little bit about Twitter versus Tesla. This is a very big check that potentially Elon Musk is about to write. Is this a zero-sum game? Is he ultimately, if he wants Twitter, he has to sell some Tesla?
I mean, maybe if he puts up the whole thing himself. He would likely, partner with a consortium, bring in some private equity and other investors with him. I think that's the most likely scenario, that he teams up with others. He will be the largest shareholder. I'm sure he will put more than the 9% stake he has right now. My guess is there will be others that come along for the ride with him.
Yigal, great to catch up. Thanks for the analysis. Really appreciate it. Such a fascinating day. We've been kind of building up to this over the last few weeks, haven't we? Yigal Arounian of Wedbush Securities. Thank you very much indeed, sir. What are we going to talk about next? We're going to take you back to the earnings season. Wells Fargo's analyst call currently underway. We've just been hearing from CEO Charlie Scharf. He's talking about wage pressures. He's actually talking about them coming down a little bit, talking about them maybe being not as great as they were in the fourth quarter. We're going to bring you the highlights from all the results we've seen today, and we've got what we're getting on these calls. That's coming up next. This is Bloomberg.
A huge day for Wall Street earnings. Goldman Sachs, Morgan Stanley, Citi, and Wells Fargo all out with results earlier today. Trading was better than expected in the quarter. The Wells Fargo analyst call is underway, and Citi's will start in about 10 minutes. Bloomberg Wall Street reporter Sonali Basak has been on the calls. She joins us now. I think one of the key takeaways from these results is going to be these enormous beats on trading revenue, essentially a winning streak that hasn't quite quit yet. I think it's fair to also assume that a lot of this is coming off simply the elevated volatility that we've seen. But Shonali, I'm looking at a VIX handle of 21, which is pretty close to our post-pandemic normal. What happens when the volatility goes away?
And we've talked about this, that volatility could have been very stifling, but there are certain businesses that really blew through the roof here. We have Goldman Sachs, which posted not just a beat, but a significant rise in fixed income trading, currencies, commodities, helped by that volatile rates and commodities environment. We also saw Morgan Stanley fall just in line about where they were last year. That's more than $2.9 billion for Morgan Stanley in FICC trading revenues, which is higher and higher than the historical that we've seen from Morgan Stanley before, really inking more than $2 billion there. Even Citigroup, even with a slight decline in the FICC business, you did have them beat expectations. And equities also, you had equities, Morgan Stanley taking the lead again here with more than $3 billion, almost $3.2 billion worth of equity trading revenue in a very tough environment, Critty.
These banks used to make a lot of money in Russia. They're not going to make that money going forward. Shonali, what have we learned about the exit from the Russian market?
Yeah, this is a great question because we're finally seeing how these losses are being contained. Citigroup we knew was the most exposed here, and we know now that their exposure has dropped by about $2 billion to about $7.8 billion, Guy. And they still have loans, they still have a counterparty exposure and derivatives, but with that said, it is much more contained, and we know that it's about $1 billion worth of Russia exposure alone when it comes to Citigroup's provisioning here. Another $900 million, when it pertains to other risks surrounding the uncertainties of the Ukrainian invasion here.
Shonali, there's a massive debate. Are we in it for a recession? Is that on the horizon? Or are we simply in a slowing growth, demand destruction kind of environment? Where do the banks stand on that? We know Jamie Dimon has been extremely vocal, saying the consumer is fine, the economy is fine. What do the rest of the banks say?
Not only do you have Jamie Dimon saying that the risk is still very low of the recession, or rather his CFO saying that, you also have David Solomon today really starting off his call here with a list of risks. One of them, and he mentioned a couple times at the beginning of this call, this risk of accelerating deglobalization here. And he said that plus the inflation impact, the risk of rising rates, all of this could be meaningful, is what he said, for markets. With that said, the backlogs, Goldman, Morgan Stanley, are still robust, are still very stable. And it seems here from the bankers that clients are simply prolonging activity here in equity, debt, and M&A markets. And you saw that a little bit today, guys, from that Elon Musk deal.
So let's talk about the outlook for advisory. What is it? It's Musk represented by Morgan Stanley, Goldman's representing Twitter. What are they talking about aside from that in terms of the outlook for advisory? It clearly is slowing down. We were talking to Laurie Calvasina a little bit earlier on. She was saying that the one thing that they're getting as they screen all the earnings calls is that the talk of M&A has gone down and gone down dramatically.
I think there's two things to remember here, Guy, and it's that as equity volatility, as it stabilizes a little bit, and if valuations are suppressed, that gives some opportunity for private equity to start showing up in a bigger way and deploying capital after record fundraising. The other thing here is that you see billionaire-led deals. You see it in the Benettons. You see it in Elon Musk. Elon Musk, by the way, has counted Morgan Stanley as a banker before. They have hired them to do many a jumbo loan for Elon Musk's mortgages here. So you see here the banks, as they're catering to their wealthy individuals, as they're catering to their corporate clients, they are finding chances for big deals in between.
Shonali, very quickly, you mentioned fundraising in particular. We talked about the advisory business. Talk to us about the ECM, DCM businesses.
Well, the ECM, that IPO activity was a record last year, and it really started to fall off at the beginning of this year. Again, it's one thing for the investors really to say that this is something where they're prolonging equity raising activity, but the M&A, Goldman still, I have to say, Goldman Sachs still brought in more than $1 billion worth of advisory fees alone. And Morgan Stanley saw their fees more than double in the advisory business. So underwriting is really what's going to have to come back in a bigger way here.
Shonali's going to keep track of these calls. She'll be back a little bit later to update us on what we're learning. Bloomberg Shonali Basak, thank you very much indeed. This is Bloomberg. So we're coming up to the end of the shortened week for Europe, around 35 minutes or so to go until the end of trading here in Europe. The Stoxx 600 up by 0.7%, led by the travel stocks today. Whiz out with some really positive guidance. The story, though, I think is in fixed income and foreign exchange. The euro being absolutely crushed. The initial statement, I thought, from the ECB actually looked moderately hawkish. Clearly the market didn't take it that way. Christine Lagarde came out and poured even more cold water on that idea. The euro's been absolutely crushed today. You're seeing a bid back into BTP, certainly at the front end. Peter Pratt's going to join us next. The ECB's former chief economist. We'll get his take next. This is Bloomberg.
At that all day yesterday.
Thursday the 14th of April, we're wrapping up a short week. However, we've got an interesting Thursday to factor in. Stocks are higher, as you can see behind me, broadly. The action, though, in fixed income and certainly in foreign exchange. The euro trading 107 against the dollar. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So as we count you down to the close, this is what the price action looks like. European stocks are bid. The Stoxx 600 up by 0.6%. Doesn't feel like a big conviction story today, though, in equities. The story is in foreign exchange and fixed income. So let's talk about the foreign exchange side of things at the moment. 107.77 is where euro dollar is trading. We saw it absolutely plummeting during the Christine Lagarde press conference. There was an expectation of hawkishness. We got dovish. communication from the ECB, a massive surprise. The market not positioned for it, or was it? Take a look at overnight hedging costs coming into today, and actually they were reasonably elevated. In fact, they were very elevated. The market was expecting maybe some swings in the currency markets. However, what we got was the downside story. I think a lot of people were probably expecting a bit of a short squeeze to the upside. Anyway, euro dollar down by over 1% today. We catch a bid in BTPs, the Italian front end, as you can see. We are moving lower on yields, which is a bit of a surprise. We're trading 42 there. We are, though, seeing a significant move higher when it comes to what is happening with the bond market more broadly. Certainly, there is an expectation of higher yields going forwards, but that certainly has been dampened today, really dampened today by Christine Lagarde. The sequence is in place, but where that takes us in terms of rate hikes, maybe being pushed a little bit further out by the market today. Kriti?
Yeah, Guy, dampened perhaps in Europe, but a completely different story when you're looking at the rates market here in the United States. And a lot of this equity action that you're going to see is simply going to be a function of the bond market. I'm going to start in the middle of this board here. The 10-year yield up a whopping 8 basis points. When you see a move that large, it's going to hit your big tech, and of course those valuations and that cash, by the way, that's on their balance sheet. It really affects their discount rate, especially in an inflationary environment. So that's really what you're seeing here. The NASDAQ down 1%, the S&P 500 down just 0.3%, but you can really see it's tech that's weighing the entire index lower. What I really want to highlight, though, Guy, because you did a great job with the rate stuff, is to talk about dollar yen. I think you were right in that a lot of what is going on today is also going to be in the FX market. You were talking about the euro, but when you see that euro weakness, it also pushes the dollar higher. This is a currency pair, dollar yen, that has very much been in focus lately as you see yen weakness. And this morning, the yen was actually stronger. That has since flipped, and this is